Hi, Kerry Grinkmeyer with Best of U.S. Homes. This is my November issue of the state of the Birmingham real estate market. I think I'm going to change it to the state of the overall real estate market. In the past, I've given you numbers of sales and such, and I want to do a little bit of that the same, but I want to get in a little more depth. Comparing November 2018 or to the prior year, we actually had a decrease in the number of home sales sold year to date in 2018 compared to 2017, down 2%. And yet we have a good real estate market. The volume, that is the dollar volume of those 19,810 homes that sold, was actually up 15%. The average sale price was $249,928. That was actually up 17%. So now you're seeing why the number of sales were down, but the volume was up, is because the houses had gone up in price by an average of 17%. The median home price in Birmingham is now up to $249,928 compared to prior year of $213,107. The number of active listings are actually down 8%. And that's again because we have a lower inventory, and they're just during the down crisis from 2008 to 2010, we weren't building homes. And so since the houses weren't being built and the demand is now up, the inventory is down. So what does that mean and what is causing it? What's causing it is we've had an increase in interest rates. Interest rates in January of 2018 on a 30-year fixed mortgage was average was 4.03%. It's now up to currently 4.668%. Well, what does that mean? Well, on the average, if you're buying you've got a $300,000 mortgage, if you'd bought in January of 2008, your monthly payment would be $100 less per month. That's why we're having a slowdown in the market in that regard. Now, personally, I sell luxury homes. I've had more activity in the last 45 days than I had in the preceding 90 days. So I'm seeing a pickup in activity. What is the most important thing that I think has happened in the prior month was the bankruptcy of Sears and Roebuck. Now, a lot of people will turn to you and say, well, that's because of Amazon.com. Well, yeah, maybe, but I think it had a lot more to do with the quantitative easing that was a part of the Obama administration back in 2009, when they saw that the housing crisis was putting people into unemployment, that there were foreclosures, and basically quantitative easing was Obama authorized the printing of $3 trillion to be lent at zero interest rate to major corporations so that they would employ more people and get business back on track. Well, as a result of that, I'm quite sure that Sears and Roebuck and Toys R Us went out and borrowed a bunch of money and geared up and went for it. Well, that was all real good until interest rates went up. And so they borrowed that money back in 2008 and 2009 for 0% interest rate. Now they're probably paying somewhere in the neighborhood of 5% for that money. That their debt service then just went through the roof on them, and as a result, they filed bankruptcy. Now, what I think you need to know is you're going to see more and more of that. Corporations who are deeper in debt, from my readings, Campbell Soup is on the wire. They're divesting interest so that they can get out from underneath their debt service. I've heard the same thing of Snap-on Tools. There's a long list of names of companies that you're familiar with that are being pressed now, not so much not so much housing like it was in 2008 with bad loans. Now it's corporations with bad loans. Now it's student debt with bad loans. Now it's credit card debt with bad loans. That's what's going, if we're going to have another debt crisis, that's what's going to cause it. And you need to be aware of that. If you're a homeowner and you plan on moving out of your home in the next 5 years, you need to maybe move your schedule up a little. If you're set and you're okay for the next 10 years, you're probably all right. But I want to show you one other thing that I have found. I've been looking for the canary in the coal mine, and I don't know that I have found it, but I want to share it with you and see what you think. Okay, watch this. I want you to see this particular stock chart. It's for D.R. Horton, and D.R. Horton is one of the largest new home manufacturers or builders in the United States. I'm showing you a monthly chart that goes back all the way to 1998 through current day. I want you to pay particular attention to this part right in here, from 202 through late 205, and look how the price of their stock just climbed up until August 205, and then started to ratchet down substantially. We're here right now at about 206. This is actually 2 years before the housing crisis, and this is giving you some measurement of how they were doing. When we get up to 208 in July, about right here, this is when the start of the housing crisis, and as you can see, by 2009 it had reached its low. I point that out because then I want to come over here to 2012 and see if you don't see a similarity from over here in 2003-4 to what's happening from 2012 up until where this is to December of 2017. Again, it reached a peak, very similar to the peak that it reached over here. So, and then it started ratcheting down. Again, look at it in comparison to it's almost a duplication. We're right here now in November of 2018. And I guess the question, and what I'm expecting to happen, is to get a little bit of a rise here through December and January. And then if it follows suit, it's going to come down, and by probably 2020, if it follows what we saw back there, it's going to be down in this range in early probably 2020. So my point is, and what I'm asking myself, as I've told you before, I'm a retired financial advisor, is this the canary in the coal mine? I don't know. I know that the market is slowing down, and I give a lot of that to the fact that interest rates have gone up and are scheduled to go up at least 2 or 3 more, a quarter of a points once in December, and then at least 2 more in the early part of 2019. Is this going to suppress the overall housing market? Now, you might be asking yourself, wait a second, Kerry, you're in the business of selling homes. Why are you sharing this information and possibly not jinxing, but putting a damper on the real estate market? My first commitment is to my clients, and my first commitment is to be the most knowledgeable financial advisor, or rolling back a bit, the most knowledgeable real estate agent in the community. And that's why I'm sharing this with you. Okay, I want to reiterate, all my job is, as I see it, is to keep you informed of what's happening in the real estate market, so that then you can take your life and how you see your life progressing over the near future and make your real estate decisions with good information. If I can do that for you, then my job is achieved. I guess what I'm telling you is that I don't think everything is as copacetic as some people would like you to believe. There's some things going on. We've just gotten through a real tumble in the stock markets. I've seen my Amazon stock price tumble. I bought in because I believe that Amazon is going to change the world if they haven't already. You as a homeowner need to look beyond just your home and just beyond your real estate and be aware of what's going on in the financial community around you so that you can make good decisions. I look around my life and I see people who live well and live comfortably, and it's about making good decisions. Well, you can't make good decisions if you don't have good information. That's my role. That's what I want my role to be in your life. I want you to look upon me as the real estate authority in your community, and if you need some advice, give me a call, and I'd be happy to share with you what I know and give you my advice so you can make a good decision. Thanks. See you next month.